The most anticipated Paris and Bazcast topic of discussion is finally here. How do you buy a property through your self-managed super fund? And today we have joining us.
Welcome to Farid from ATP Accounting and Rosario from Wealth Inspired. Thank you guys for joining us. Really pumped and excited session ahead.
Absolutely. So we've had
Thank you for inviting us.
Yes. There you go. We've had so many people express interest in this topic. It's definitely a topic that people would want to know a lot more about. And I guess the question starts is, what is the process? How do you actually, where do you start?
I think you start by going to your accountant, right?
Of course. Become the accountant.
Apparently, we are the most trusted advisors, but let's not be too pushy there. So basically, look, people come in and they ask, I want to buy a property through my superannuation. Yeah. Being accountants, we say, look, this is financial advice, and you need to sort out your suitability to get that property through your superannuation. If you speak to a financial planner like the awesome Rosario, and she can basically analyze, go through, a discovery session with you and find out, firstly, whether it is a suitable investment, because at the end of the day, it is an investment. You are really investing to buy a property, and to analyze whether it is a good investment for you with the plan that you want to do or not. And then from that, we basically go to the steps of establishing the superannuation fund, which is a type of trust, and have a corporate trustee. You do the rollover of the superannuation, and then basically you go and get your loan sorted out and the property that you want to buy. And then we set up, if you are going to borrow to buy the property, you need to set up a bare trust, which has the relationship between the lender and the self-managed super fund. And then you basically buy the property, you have your accounts done every year, and then have them audited. So the first step is basically you need to go and speak to a financial planner to analyze your situation. So Rosario, can you fill us up?
Yeah, what happens when a client comes to you? What do you go through?
I think the most important part of evaluating if a client is suitable for an SMSF is education. So we run through the suitability of a self-managed super fund by actually explaining what the structure looks like. So there are 3 parts to it. So we explain the structure that needs to be established, like Farid said, you have your trustee, you have your corporate trustee, and why you would do it through a corporate trustee, and then the bare trust that needs to be set up. And then we talk about the investment strategy that is part of what the lender and the regulator needs to see, that you've got an appropriate investment strategy, and that's why it's suitable. So it's not about the account balance, it might be to do with the investment strategy. So we run through the structure, we talk through, what are the considerations and what are the obligations, and just make sure that there's no red flags, that the client's not thinking, oh, they're going to live in the property or they're going to rent it out to a family member. Suitability means that they understand what the fund can and can't do. Okay, so then we run through all the support team that we're going to pull together to actually help them achieve this, because it is a big strategy, right? So we've got Farid, the accounting part, we've got the mortgage broker, we've got the property advisor that's going to help them through that, conveyancer, building inspectors, all of that, so that they understand that it needs to be set up correctly and all these things need to be done. Okay? And then we talk about all the costs associated with that. So we talk about what do you have to consider upfront and what do you need to consider as an ongoing cost. Okay, and so all of that is vital because it ticks all the questions that normally people ask. What does it look like? Who's going to help me from setting up and also running it on an annual basis? And what are the costs associated compared to where I am right now? Where is it going to take me? Is it going to achieve what I want to do? So I go through that. If the clients come across as, yep, they get it, because it is effectively a self-managed super fund, which means that they as trustees have the obligation to actually approve any decisions. So yes, they can engage a whole team of people to give them advice, but they ultimately are responsible for it. So they need to take all those boxes to be able to say, yeah, this is suitable for you. And then, yeah, go back to Farid. You can now set up all your structures. And our role is more like a project manager as well, so that we help them to make sure that all the steps are done correctly. And once this fund is set up, then we go on to the mortgage broker, the property advisor, and start sourcing all those things to make it all come together to help them bring it about. Okay?
It's very important to have a very good team for the client, because if one person is not performing, I think the deal can go pear-shaped. So everyone has to do their job to get the deal over the line. Definitely.
Yeah, and I feel as a financial planner, my role is to get the client to where they need to be for retirement. So I've taken it on to make sure that I project manage everything and that I keep on top of everything that's going on. So I'm like their CEO to their company. So effectively, they appoint me, and I'm there doing it for them to help them.
Exactly.
And I think there's a couple of points that you mentioned, Rosario, which is very important with regards to property. So what you need to understand, basically the difference with the types of properties, if a person is buying a residential property, they cannot live in it. They can't have anybody related them by marriage or by blood living in it. If it is a commercial property, or what is referred to in the legislation as a real commercial property, you can have a lease as long as you're paying a market rent from your entity. So say, for example, you want to buy an office complex or an industrial unit, you can buy that under your self-managed super fund, and the self-managed super fund can rent it to your company as long as you're paying market rent and declaring that for the superannuation. But you cannot live in the property, which is something very important, because a lot of times people think, I'm going to buy, say, a holiday home and put it in my self-managed super fund. Well, you can't do that. The rules do not allow that, because as Rosario mentioned, the whole idea of superannuation is to preserve funds to retirement, to give you the best returns, so that when you are in retirement age, you are able to access funds to support your retirement.
Correct. And I think a lot of clients are unaware of which securities are acceptable as well. In the super fund. So there's a lot of different types of securities out there. So it's very important talking to your finance broker to make sure that you've got the right security in place.
What are some of the securities?
So you've got to be careful. You can't do any construction. So you can't, any property that's under construction, you can't do it through a super fund. You can't have a granny flat when the property through a super fund. So it's very important to know what you can and can't do. And also, when it comes time to do the finance, we normally, before we do the rollover, Farid, you could correct me, we normally say we should get a pre-approval done as well before you take the steps in setting up the entities, because there's a cost involved. You don't want the finance to fall over and you spend all the money doing the rollover. And setting up the company.
Good, Dave, and that's part of our role as well. We obviously have done this long enough that if the client, because I do a quick, obviously, evaluation, because I deal with the mortgage brokers on a daily basis, I do my evaluation up front. But if I think it's a bit tight for what they want to do, we set the expectation for the client. The client comes with an expectation that they're going to buy a property of specific price point. I need to reset their expectation and go, no, look, this doesn't look like, as far as my calculations, that you will be able to access that price point. So are you okay with this? But if the client needs the reassurance, and there are some clients that need the reassurance up front, even though I can reassure them that I've already done this, I normally go back to the mortgage broker and say, can you do a pre-approval? Not a pre-approval, but your modeling and your evaluation that this is suitable. I do it for my own sake, but the clients also provide it to the client to actually reassure them that we're not going to set up something that they're not going to be able to use.
Exactly, because with super fund lending, the LVR restrictions, security, postcode, it's all a little bit different from normal residential lending. So there's more paperwork involved, more time, and the main thing is not many lenders are doing SMSF lending in today's market as well. So and the rates are slightly higher than normal residential lending. So these are all the things that clients need to be mindful of.
And what would be the minimum amount you need to have in your super to be able to purchase?
Normally the bank's rule of thumb is 2 to 250k to have in a super fund to make it worthwhile. Every lender is different, but that's basically the ballpark figure that we work off. So anything less than that, normally the banks aren't comfortable because there has to be enough liquidity ratio left in the fund after purchasing the property.
Yeah.
And it's
Yeah,
also
that's right.
depending on the property you're going to buy. So
Correct.
the higher the
Yeah,
price
well.
of the property, the more you need to have
Exactly.
funds to be able to pay for the deposit and have that availability to pay your ongoing expenses for the self-managed.
Correct.
Yeah,
Correct.
and one big note, Dev, is that it's not always just a servicing evaluation. That's your role, correct? For myself, it's also about affordability because I can have a mortgage broker confirm that it's affordable upfront because it looks like it looks fine on paper. But when I talk about affordability as in kind of like a household where you go, okay, you're buying that investment property, the return is like 6%, your interest rates are only 2.5%, and you look at that and you go, that services because there's more rent. But then you look at the household expenditure, the real household expenditure, you go, it's not affordable. So that's what I do with the self-managed super fund as well. Yeah, it could look all good on paper, but then the fund has got, for example, ongoing insurance costs because the members need it. And so that's going to be detrimental to that, and it's not going to be affordable. So you look like the first year looks great, the second year looks great, and then the fund is depleting its account balance to the point where it can't maintain it.
Yeah.
So I look at the long-term affordability as
Very
well.
important. It has to be self-sufficient over a long period of
Yes,
time.
correct. Yes, because it's a long-term strategy.
Yeah.
So maybe we can touch to make it a little bit clearer, Rosario, on what you're saying. For the self-managed super fund, it basically has the sources of income is the contribution that the fund receives.
Correct.
So if the person is working, they are contributing to the self-managed super fund. So that's a source of income to the superannuation fund. And also when you are renting the property, that's another source for the super fund. And then it has ongoing expenses. So things like, for example, your interest to the loan that you have to service, your accounting fees, your auditing fees, your insurance. So the insurance that is being paid by the self-managed super fund, it's also an expense. So basically at the end of the year, you actually calculate all the rent, all the contributions that's been received by the super fund, deduct all the expenses that has been paid, including such things as depreciation, if the property is new, and all the other expenses. And then you end up with the net profit. Based on that net profit, then the superannuation has to pay 15%. So this is something that's an advantage under the self-managed super fund, is you only pay 15% tax. And if you do end up selling the property and make a capital gains, you only pay 10%. But guess what? The good thing about being inside the super, if you are retired, you're paying zero tax. And in fact, if you do sell it and make a capital gain when you're retired, you are actually paying zero tax. So that's a big advantage of having it inside the self-managed super fund. But talking about security, because you mentioned security, Gurdeep, before, people need to understand that as you go along and the property is increasing in price, you cannot use that as a collateral to buy another investment property. And that's the main difference of buying property inside and outside superannuation. So when you are outside the superannuation, if you have equity, you can go to the lender and say, look, I have that much equity. Can you please lend me and buy the second property? Inside super, you cannot do that because each property needs to stand on itself and it cannot be used as a collateral or a security for another property.
That's a very big, I've had a lot of clients fall into that trap. They thought we got two unencumbered properties worth $2 million. I can use that collateral and buy a third property, but it doesn't work. Super has to be sufficient and stand alone.
And this is why it's really important to have a financial planner as well, to review your strategy every year and actually work out how to maximize your strategy, because this is exactly what we do for our clients, that if they have a certain amount to start with and then we know what their investment time frame looks like. So if we know that we're seeing clients at the age of 45 and they would like to retire early at the age of 60, then we've got 15 years to work with them. And so we actually work out how do we maximize that strategy? And that's where we come in. And it's not, we're not trying to tell the mortgage broker how we want the loan set up, but if it's best for them because they've got 15 years to take out the maximum loan to value ratio, which is 80%, then we do that. Is it interest only, or how does it maximize the strategy over that long period of time? So we actually strategize that with them to make the most out of it. Okay. So obviously going back to the mortgage broker and saying, hey, this is what we're proposing. Can we do this? Okay.
Absolutely. Yeah. We've just had a question. I think we just answered it earlier as well. The minimum funds to have in the super. When Rosario, when you're dealing with your clients, what have been the statistics that you've got? Like, what amount are you working with?
Yeah.
As a minimum.
That's a really good question. Look, ASIC's guidance is $200,000, and the reason why they've done that is because when you compare a retail or industry super fund management costs, it is based on a percentage amount. So they could be anywhere between 1% and 2%. So if you do a calculation on $200,000, you'll say you're paying anywhere between $2,000 and $4,000 to run your own retail or industry fund, okay, with $200,000. You take that amount of money, you put it into a self-managed super fund, and you actually calculate the cost of running your self-managed super fund that is now no longer in a percentage-based environment. It's actually in a dollar-based environment because the costs that we have, accounting, insurances, and so on, are all related to a dollar fee. So that's why ASIC has said that's when you're probably going to be in the same situation or maybe better off from then on. So that's what we work with. Now, in terms of where we actually help our clients, we can start with account balances of $160,000. Okay. Yep. And the question there is how much contributions are coming in. So if a couple has combined income of about $120,000, yes, we can work with them. And this is to do with the type of properties that they might want to buy. If they're comfortable with a new dwelling at $160,000 with $120,000 of income, right? We can actually enter the market at about $400,000 new property. Okay. If they've got less than $160,000, we need to set the expectation that they only could afford potentially an existing dwelling of under $400,000. So it's all about if they're okay with the type of property that they could afford, and sometimes getting in the market is all they want to do. Yeah. So they don't have any expectation. It's more about, can we do it? Is it affordable? Can we maintain it long term? That's what the equation ends up being.
Yeah. Okay. It's all about creating wealth, and you're owning another asset without technically affecting your cash flow buying through super. So if you can,
and maybe people what they can do, Rosario, is they have now the new rules where you can catch up with any superannuation they haven't paid through the last few years. Maybe you can touch base on that, Rosario, and explain how you can actually beef up your super if your super is not that big. How can we do that?
Yeah, that's excellent. Yes, effectively, if clients haven't actually, if they're self-employed, obviously they're going to be trying to minimize their taxable income. So they're only paying themselves up until the 30th of June, only 9.5% of what they've declared as income. Now, from the 1st of July, it's 10%. So that's self-employed people and business owners, right? You try to minimize. Obviously, employees, they get 10% of their gross salary. That's awesome. But if their employer, if their income is below, or their super contributions was below $25,000 until the 30th of June, and they've got a cap, so if their employer only contributed $10,000 out of the $25,000, then they have an unused amount of $15,000, which they can actually contribute into their self-managed super fund because it's an unused amount. So there are opportunities there to bring some more money into their super fund, and they can obviously go back to their accountant and then claim a tax deduction for that money that they're bringing in, because they're going to bring it in from after tax dollars. Okay.
And they can go back how many years?
2 years now. Well, 2 years effectively, because it's already more than
next
1 of July. Yeah.
You can do a catch up. If, for example,
you can do a catch up.
Yeah.
Very good.
Yeah.
There you go.
A lot of detail.
Yeah.
So I think it's very important to have a very good team,
Good.
as we said in the start, to make this happen, and you keep the property long term as well. Yeah.
And if there's any other questions as well while you guys are watching, feel free to type them here or even afterwards as well. We're happy to come back to you afterwards. If there's anything, we'll be tagging all of the guest speakers, so Rosario and Farid here, or in individual chat as well. And again, from a finance point of view as well, that's the critical part. So we're here to help you and answer any questions from finance and real estate as well.
And we can find the property as well.
You can find you the property as well.
Right.
That's it. One-stop shop. Perfect. So is there any other sort of commonly asked questions that we haven't yet answered from your profession about the purchase? Anything else that comes to mind?
I think from my end, the point that Gudeep mentioned at the beginning is that please do your figures before you do the rollover. Because realistically, a lot of times people get excited. They hear about their friend who just bought a property using the self-managed super fund, and they think, well, I can do the same. They go and establish a fund, they roll over the money, and then they find, well, based on the money that they have, they can't really buy anything. So I think it is very important that you speak to the team before you actually do anything, because the worst thing you want to do is establish it and leave it in the bank to earn 0.5%. That's really not a good investment at all. Or at the end of the day, after you've paid all of these costings, you actually go back and you have to reverse it back into a retail fund, and you would have lost a few $1,000s in the setup. And I think also the idea is that you need to remember that with the property, you cannot, whatever asset that you have in the self-managed super fund, you cannot use that for private use. So very important with residential, you cannot live in the property, and you cannot have anybody related to you by blood or marriage live in that property.
Yeah. We've got a question here.
Oh, sorry, I was going to just reiterate about the rollovers. It's really important that you get advice on your existing super fund. People don't close their existing funds before they get advice about any benefits that they may lose when they do that. So we always do a partial rollover until we replace whatever benefits are in that fund and work out if we can replace them. And I'm talking about the benefits that I'm talking about is life insurance. Anything that's held in there may not be able to be replaced for a better policy, or because the members have had health issues and they cannot get a new policy. So it's really crucial that they do not roll over the full amount, and get some advice on that. Okay.
That's
very important.
Okay, so the question that we have is, so to sum it up, if can more than one couple, so 3 couple friends, combine their super to purchase a property together and then split the income, I think, as I understand it here. So if yes, can any accountant help in dividing a property in money in as investors and out as profit?
So using
3 households, 3 couples coming together to combine their super to buy a larger property. Is that a possibility?
So with superannuation, you can only have 4 members. You cannot have more than 4 members inside one self-managed super fund. So therefore, if you have 3 couples, you say? That's 6 members. So you cannot have 6 members inside a self-managed super fund.
Sorry, Farid, can I correct you? I'm so sorry. As of the 1st of July, we can have 6 members.
Oh, yeah. Okay. Awesome. Oh, that's good. All right. Awesome. So we can have that.
Yes.
That's good. Good change.
Okay, so you
can. It got approved. Yeah, it got approved. It got passed.
Okay. So I guess then the next question is, if they do buy it together, how does it all work to divide the income out of it?
So can I answer that quickly? When the funds, so people think that because you're bringing all your super funds together, that all the funds are all mixed in together. They're not. Effectively, you actually bring in your account balance and you maintain your account balance. Okay. So the only 2 things that proportionally, you've got a proportion ownership of that fund, okay, of the total amount with your account balance. So you maintain your own account balances. The two things that will move your account balances independently of each other is the super contributions that your employer is making will go towards your account balance. It's not going to be split amongst everybody, okay? It's not get pooled. It actually is contributed to yours. If you have insurances like personal insurances in your name through the super fund, that premium will get deducted from your own account balance, okay? But everything else is proportionally split in the fund. So you will receive earnings proportionally to your account balance in the fund, and expenses will be charged to you proportionally to your account balance. Okay, so you maintain your own account balances,
That's pretty
but
cool.
you're investing together. Okay.
So each member basically has an account. So we have member 1, member 2, member 3, member 4, so on and so forth. As the money comes in, each member has their own account with income and expenses. So the income being the contribution and their portion of the rent, and the expenses, like Rosario has mentioned, if they have their own personal insurances, then that's deducted from their account. But Rosario, with having one fund for everyone, and say one member pass away, what happens there? Can you explain to us when you have 6 members?
Oh, okay. Well, it all depends on their nomination, of course. And so obviously if they have a life insurance policy or they have insurances as well as their own account balance, it will all depend on their nomination. If they nominated that their partner, their wife or husband is in receipt of that, that can actually be transferred onto that other member. Or effectively, if they actually nominated somebody that's not part of the fund, then obviously that needs to be paid out of the fund. Okay?
Is it a problem if those couples are of different age gaps? If there's age gaps between those couples, Rosario?
Yeah, you have to. If there is a huge gap, we have had, fathers and kids, parents and kids have set up. But if there are couples, the only situation that you need to consider is when the oldest couple reaches retirement and they want to start taking down a pension. So you need to be aware that at that stage, obviously, their super contributions stop and they need to be paid out a pension. So the fund needs to have enough liquid assets or liquid, investments where they can draw down those pension payments and meet those requirements. So that's the only thing that you need to consider, or you need to sell down some assets to make sure that that's available to them.
And if you only have property,
yeah, that's an illiquid asset, so you need to be careful.
It becomes a bit of a problem because you can't really sell a room in the house. You have to
you can't say, okay, the value of that property, we're only going to put a portion of that towards this member. So you need to work that one out, in advance, actually.
Perfect. Well, there you go. Well, thank you so much, guys. We've learned a lot, all of us. I think everyone that's watching as well would agree that I think it's one of those things that the more you talk about it, the more you want to ask questions. How does this work? What can I do here?
Technical, anything's possible.
Anything is possible. There you go. Perfect. Any final words before we finish off?
Seek advice. Have the right team around you, between the accountant, the financial planner, the property advisor and the mortgage broker, and of course having the right solicitor, because at the end of the day, or conveyancer, because at the end of the day, I always say the client needs to be in the middle, serviced by all the different professionals around.
Correct.
So very important to have the right team around you, because they are the ones that look after you, basically.
Yeah, correct.
Thank you guys.
Perfect. Well, thank you so much for joining us. Really appreciate it. And as just decided, next week we have Farid back with us again to talk about the current scenario with the COVID. What is exactly the title? The demystifying.
So demystifying. If you are in New South Wales affected by the lockdown, the government has actually given out some support funds to individuals and businesses, and there is a lot of information that needs to be sort of given so that you can access those COVID assistance packages. And so if you want to dial in next week and hear all about it, and we'll tell you what you need to do.
What you need to do.
Perfect.
Perfect. So 3 o'clock next Thursday to talk about the COVID help that the government, New South Wales government, has offered. Thank you very much for listening. We will see you guys next time.
See you guys.
Yeah.
Thank
Bye.
you, everyone. Thank you.